Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio of Eric Cerner, Chief Investment Officer at Apollon Wealth Management, to discuss his 2023 outlook and what could be a flat market for the year. Eric, it's great to have you with us. Welcome to Trade Talks.
Oh, thanks for having me.
You got it. Apollon, you're calling for a flat market in 2023. What does this mean for active managers?
Yeah, I think over the past 20, 25 years, we've seen a lot of passive and index funds really take a great deal of market share from the active managers and outperform the majority of them just with the bull market. But given where we are with the economic environment and the inflation, we expect the markets to remain flat next year as the Fed keeps restrictive rates over us, as well as we continue to fight inflation. So while we have a flat market, I think that's a great environment for active managers to once again prove their value. If you look at the active manager success rate and beat the benchmark, it's varied by asset class over the years, but the one asset class that they've always consistently struggled was large cap. And if you look at 5-year time periods, only 10% beat their benchmark. Shorter time periods, it could be only 15 to 20%. But so far this year, 57% of large cap managers have beat their benchmark, which is the highest in 15 years. So we expect that to be an opportunity for active managers. And as we look at models and invest our clients' monies into ETFs and mutual funds, we may be paying more attention to actively traded mutual funds given the flat market expectations.
Do you think the companies are going to start to feel the pressure of the Fed rate hikes and what's happening with inflations? I mean, at some point it's going to impact margins and earnings.
Yeah, absolutely. And we're seeing that right now with the most interest rate sensitive sectors like housing. Housing's come to practically a screeching halt. Technology, we're hearing more layoffs in the technology sector. And that's been about it so far as it seems like the other sectors have held back on layoffs. It's such a tight market. I think people are still fighting for talent. But as we look forward and looking at the fourth quarter guidance, we saw that twice as many S&P 500 companies have issued negative guidance as opposed to positive guidance. And even this past third quarter, we've seen profit margins go down for the 5th consecutive quarter. So we're going to continue to see that trend. They're still very healthy at 12% net profit margin, and that's still above the 5-year average. But we expect that trend to continue, downward trend of other sectors really feeling the effects of all these rate hikes in the fourth quarter as well as into 2023.
Well, CPI and PPI, the data's starting to soften just a bit, which is a good thing.
Yes.
Do you think the market reaction to that perhaps could have been overblown a bit?
Absolutely.
Yeah, because I mean, if you get the printer on 7%, I mean, things feel exponentially more expensive this holiday season. I mean, Thanksgiving dinner was up an average 14%. It's a lot higher than what CPI and PPI are showing. Yeah,
no, I think it was welcome news, both the CPI and the PPI. But to see the market jump up 5%, it's going to be a very short rally there because we still have a ways to go. If Fed Chairman Jerome Powell has repeatedly said that they need to see a sustained downward trend and to get down the target of 2%. So we're at 7.7. We still have a long ways to go. So it's great that we're taking a step in the right direction. But I think it's going to take all of this fourth quarter or even 2023. And I don't even expect inflation to be back down to 2% at the end of 2023. Hopefully we'll get it between 3 and 4%. But we still have a long ways to go. So I think that market reaction on that day was way overblown, and we're not going to see a sustained rally until we get inflation back to normal levels.
But even with a slowing economy, you're still seeing opportunities elsewhere in the market. So what are some of those opportunities?
Yeah, no, I think there's plenty of opportunities, and some investors can sometimes be scared when you hear about bear market and recession, layoffs, inflation. But there's incredible opportunities out there. You think back to spring of 2009 when the S&P was under 1,000 during that bear market. If you invested then, you're very happy right now. The same thing right in March of 2020. So for investors with time horizons of 2-3 years or more, the valuations have improved. We see the S&P 500 large cap companies, their valuations, the PE ratios were over 25 last year, and they've come back down. They're about at the 20-year average right now. And international equities, while international equities for the short term face more headwinds, their 20-year valuations actually, their current valuations are below the 20-year averages. So I think there's great opportunities to get into the market now for long-term investors. And even for investors with shorter time periods, the good news with all these rate hikes is it's helped normalized, the fixed income market. So we see a lot of attractive yields out there. And what catches my eye the most are the investment grade bonds or funds out there paying 5 to 6%. And I think that's what investors should focus on. You see the high yields paying a bit more, but we are seeing increasing odds of a recession. And within the high yield sector, that's when you're going to see some potentially more defaults. So I think the investment grade options within the fixed income market are great opportunities for investors. And even for investors with equities in this market, there's opportunities to look for more dividend paying or high yielding mutual funds or ETFs that maybe put a bit more allocation on the defensive oriented sectors like healthcare, utilities, even high yielding financials. So there's a lot of great opportunities still out there, and investors should remember that the stock market is forward looking. It's going to recover before the economy does. And that's why it's important to stay invested and just, block out the noise and stay disciplined to their investment plan.
Yeah, all great points. Appreciate the insight, Eric. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.